Howdy, friends. Joel Garris of Nelson Financial Planning here. Welcome to Dollars and Cents, Central Florida's longest-running radio program, beamed all out throughout social media as well. On the program today, we're going to give you the latest on Bitcoin. Remember that? We've got some interesting results courtesy of a study that was done by a couple of different professors on some of the activity that was happening between March of 2017 and March of 18. If you remember, that's when Bitcoin jumped all the way up to 20,000 and it was going to replace the US dollar. Remember that? A lot of people were saying that. There's an interesting follow-up to that. So we want to give you the latest on Bitcoin. Plus, we want to share with you the single most powerful tool when it comes to boosting your retirement savings. So that'll be pretty interesting. All that and more, of course, each and every week on the program here on Dollars and Cents on News Radio WFLA Orlando. To get started, I thought we would spend a little bit of time talking about a concept that we hear a lot about, but we want to relate it to your investments and your finances. And it's this process of what a lot of folks refer to as creative disruption, this ongoing process that really makes America unique in the world. Is you constantly have, because of the rules that exist in America, where it's not protecting an industry for the sake of protecting an industry, or protecting a company for the sake of protecting a company, or a government running an industry for the sake of running an industry. What makes America unique is you have this awesome creative disruptive force, which simply means that if somebody invents a better mousetrap, or somebody invents something better than the mousetrap — I personally prefer those glue stick things. Those actually work a little bit better and are kind of less gross to deal with. Anyway, we digress. The reality is that the economy here in America is set up to encourage, in fact, foster that kind of behavior. And certainly the examples throughout history are pretty widespread, right? I mean, Ford put out of business the buggy whip manufacturer, right? And Walmart certainly put out of business a lot of stores. And today, Amazon is doing just that same thing to most retail shops. So we see those all around us. And that's one of the things that makes America unique, and one of the biggest reasons why I believe that the U.S. economy is as powerful as it is because you don't have any of those sacred cows, so to speak, that are protected. Hey, if somebody can come up with a different way of doing things and do it differently and do it better, and ultimately that appeals to the consumer more, well, then have at it. Have at it. And the examples are enormous. Right now, the two of the biggest examples that we hear a lot about are this concept of 5G technology, or this concept of AI, artificial intelligence. You hear the ads about AI all the time on television, talking about AI and who can provide AI better than the other person. So you see all of these concepts, hear all of these concepts, and it's important to think about those from an investment perspective and from a creative disruption perspective, because the reality is that if you think about like 5G technology, right? So the transition from 3G to 4G ultimately sped up things by a factor of 10. What 5G is going to do is it's going to speed things up by a factor of 100, which that's a light year jump from 4G. And why is that important? We'll stop and think about what folks refer to as this Internet of Things. And this Internet of Things simply means that you have a lot of things connected to the internet that in the past you didn't have. Just stop to think of some of the easy examples, right? That doorbell that you can see the burglar coming up to the front door to steal the package, right? We've all seen those commercials. That's connected to the internet. Your thermostat, or at least I have one at my house that's connected through the internet, and not quite sure how it completely works, but I know it's connected to the internet. My security system, your everything, your refrigerator. I mean, some of these examples are kind of crazy when you stop and think about it, but they absolutely exist. And so consequently, all of those devices need bandwidth. They need space to run down the internet. And so what 5G does is it increases that by a factor of 100. So pretty powerful, pretty amazing stuff, especially because they're able to do it with a much shorter response time to provide that much faster bandwidth. And particularly as we go to this Internet of Things where all this stuff is connected so that we can look at it on our phones, the reality is that that's what 5G brings to the table. The other thing that we hear a lot about is, of course, artificial intelligence. And that doesn't mean that some machine is making decisions. That just simply means that the computers are looking at the data and drawing a conclusion from the data. But the data that they're crunching, if you will, is massive. And I guess the easy current explanation of where that data comes into play is on an autonomous vehicle, right? I mean, imagine the data that vehicle has to process, not just geographically, but in terms of its surroundings. That's a tremendous amount of data. And so what artificial intelligence is all about is that it takes that massive amounts of data and ultimately boils it down to a yes or no. Does the car stop now or does it proceed? Is it okay to take the right or not? That's the kind of data that we're talking about when it comes to artificial intelligence. And we see that in everyday life, and we're going to continue to kind of see that going forward. So as you look at all this creative disruption that exists and that has existed, what's it mean from an investment perspective? Well, at the end of the day, what it means from an investment perspective is that in any industry, there are going to be winners and losers. There are going to be companies that make it, and there are going to be companies that don't. There are going to be companies that do it better than their competition and ultimately rise to the top, and ultimately the competitor sinks. That's how it works. So from an investment perspective, that's one of the biggest reasons why we believe in active management internally in the investments that one owns. Because without that active management, you're not going to that company that's doing it better. If you're using an index fund, if you're using an ETF, those are pre-packaged based upon everybody in that sector or everybody in that index. And when you use those types of investments, there's no distinguishing between who's doing it better and who's doing it worse, who's winning, who's losing. And so from an investment perspective, I think there's no time like the present, and probably going forward in the future, where that concept of active management inside of your investments, rather than just owning these baskets that are static, that don't change, is going to be crucial for achieving the best possible investment return over time. So take a look at that in your portfolio. Make sure you're not too heavy on all that index and ETF stuff, because the reality is that just means you're owning everybody. And there's going to be some winners and losers out there, particularly going forward as this creative disruption process continues to run in the American economy. We'll continue the conversation here on Dollars and Cents when we get back here on News Radio WFLA Orlando.
It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. This is Joel Garris of Dollars and Cents with Nelson Investment Planning Services. That's the old name of the company. Right now, we're known as Nelson Financial Planning. We thought we would give you the latest on Bitcoin in this segment of the program. That's that currency that was going to take over the world. That was the currency that was going to be free from any and all government influences or bank influences, and it would just be free to be a true reflection of currency value. And that was what was going to take over the world. It was going to be a new world, a new dawn. And with that mentality, with that logic, we saw the price increase between March of 2017 and March of 2018. We saw that price increase by nearly 100%. Price of Bitcoin went up to $20,000 per coin. And the reality is, what we were saying on this program back then was, it is a piece of paper. It's not backed by anything. It's got nothing backing it in any way, shape, or form. The behavior of Bitcoin, the obsession with Bitcoin, we believed was 100% unfounded. Well, come to find out, we were quite right on that. Based upon a study that was done by a couple of different professors, published in the Wall Street Journal and other journals of financial acumen. The reality is that they crunched 200 gigabytes of data. And what they learned is shocking. What they learned is that nearly 60% of the market movement in Bitcoin during that period of time can be traced to a single account. One person, one entity was able to drive the value of Bitcoin up that dramatically. Oh, wait a minute. This was supposed to be the currency that was free from any manipulation, free from any government involved. No way it can be manipulated. Yeah, right. Okay. All it takes is someone to be a little craftier in an unregulated market, which is what Bitcoin is, an unregulated market. And so consequently, you can, in fact, manipulate it just like anything else. So they looked at the data, and here's what they found. There was a single account at Bitfinex, which is, at the time, Bitfinex was the largest crypto exchange then. What they were doing at Bitfinex in this account is they were using a second crypto called a Tether to boost the demand for Bitcoin. Now, Tether was supposed to be something that was known as like a stable coin, meaning that for every Tether that was in play, there was $1 backing it in reserve. That was at least the argument or the theory. So what they were doing with Tether and the account at Bitfinex is they were able to drive up the price of Bitcoin. Unfortunately, when you start to crunch the data, there was a noticeable pattern that this study detected over a 95-hour period of time. We're talking 1 year. The study found, based upon the trading records, 95 hours, and those 95 hours accounted for 59% of the return of Bitcoin. Interestingly, Bitfinex, the exchange through which the account was trading, and Tether, the coin that was being used to increase the price of Bitcoin, just so happens to be owned by related parties. And now, Bitfinex and Tether and the companies and individuals that own them are being investigated by the Department of Justice and also the New York Attorney General's office. Folks, it's a very simple moral of the story here. And I'm reminded of the conversations that we had back then. People calling the office. People calling. I mean, it was constant. Oh, how do I get Bitcoin? That's what I need. That's what I want. Okay. And I remember we did a radio program talking and comparing Bitcoin, okay, to the tulip bulb scandal in the Netherlands back in the 1500s. The normal things that happen throughout society, people for some reason throw out all logic and believe that something's value is going to go to the moon. And the reality is that it's not based upon anything. And then when everybody eventually just kind of wakes up and the emperor has new clothes, well, guess what? No clothes on. Well, guess what happens? Value falls pretty dramatically. And certainly this appears to be where Bitcoin is headed, because if you can manipulate it that easily, single account, out of a single exchange, using a single tether currency, then you got to question, okay, well, what's the real value of it? Much like you have to question of what's the real value of a tulip bulb back in the 1500s in the Netherlands. The moral of the story, as with anything, is if it sounds too good to be true, if something is going up and there's no logical explanation for it, there's nothing backing it, there's no substance behind it, then the reality is, and as an investor, you should stay very clear of that. But many people got very enamored with Bitcoin. Many people got very excited about it. Many people wanted to invest. Many people wanted to own it. Okay. What's fascinating is, as is typically the case, and this has happened time and time again, when you have something like that has increased dramatically in value and it's attracted attention and the world is just fixated on it and the attention is just pouring in and the price keeps going up, be careful. Particularly with the single biggest issue that we've always had with Bitcoin is that there is absolutely no regulation whatsoever on how that value is set. And for something to be billed as it's going to be free from any and all manipulation, we're going to get the governments out of it, we're going to get the banks out of it, we're going to get all of this out of it. And the reality is a single entity can drive 60% of the price. That's not exactly structured the way it is billed now, is it? I suspect that this may also have been a large part of why the Libra currency that Facebook was rolling out all of a sudden kind of fell apart. Because when you look at studies like this, and these guys did a tremendous job cranking through 200 gigabytes of trading data to find 95 hours and be able to trace it to a single account on a single exchange. That's pretty amazing. And so I suspect that may be why you saw this announcement about Libra and this cryptocurrency that Facebook was rolling out very quickly devolve into the dust because of studies like this, and perhaps this study, because this study it just came out, and so I'm sure the folks at Facebook were aware of it, and certainly it just underscores the difficulty of trying to create something out of nothing. If there's nothing there, then there's nothing there. And if there's nothing there and there's no rules and regulations behind it, guess what? It can get manipulated pretty easily. And consequently, that appears to be the story behind Bitcoin. So hopefully you didn't get too sucked into that Bitcoin nonsense. Again, from an investment perspective, if it sounds too good to be true, it is. With that, we'll take a break and return. This is Joel Garris of Nelson Financial Planning on Dollars and Cents News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio WFLA. This is Joel Garris of Nelson Financial Planning. And wasn't that fascinating, the conversation we were having in the last segment about Bitcoin and how much the manipulation existed? Fascinating study that just came out that showed that nearly 60% of that run-up of Bitcoin price actually happened in a single account on a single exchange, as is always the case. If it sounds too good to be true, it probably is. Couple that with the fact that if something is completely unregulated, you really don't want to try and invest your money in that way. So some interesting stuff coming out. I would speculate that that's probably why the Libra at Facebook probably has kind of fallen into the background as the study was coming out, because this study is pretty powerful about the ability to manipulate things that, there's no way you can manipulate it. Well, yeah, of course you can. If there's no regulation, you can manipulate it. And even sometimes when there is regulation, you can also manipulate stuff. So be careful. If it sounds too good to be true, it probably is. Speaking of things that aren't too good to be true, we're going to tell you about the single most powerful tool to boosting your retirement savings. And really what this is when you are an employee and your employer offers you some type of a retirement plan, be it a 401k or a 403b or 457, those plans these days actually come with a lot more bells and whistles than most people realize. And because in today's world with technology, you have a tremendous amount more online tools that are available through the plan that your employer offers. And what's disturbing is that when you look at the statistics, many people don't even bother to use those tools. So it's important to use those tools as part of your overall planning and putting money into your employer plan. So there's a lot more tools available that sadly people are not using. And similarly, the advent of the asset allocation funds, which, I mean, we've talked about those in the past. There's some pros on those and there's some cons on those. The biggest pro is it does simplify the decision that you have to make as it relates to your investment allocation. The big con on that is that it simplifies it in such a way that it drives you into a more conservative investment allocation than you may very well realize. So that's the biggest con to those asset allocation funds, is that if you kind of lift up the hood and look underneath, you'll find that they're much more conservative based upon the year that you're selecting than you might think they are. It's almost like if the year you pick is the year in which you retire, the investment allocation is almost going to look like you're going to die that year. It's so conservative. So that might be a little overstatement, but you get the point. The asset allocation funds, though, are another useful tool that has happened and been created in a lot of employer retirement plans. Other tools that are pretty widespread in employer plans these days are some of the automatic rebalancing types of tools. So that with rebalancing, let's say you go through a period of time, much like we've had at the beginning of this year, since the beginning of the year, the markets are up pretty dramatically. And so the equity side or the stock side of your investment allocation is probably bigger than what it was previously. And so correspondingly, it now has a bigger portion of your overall asset allocation because of that growth. Well, you may want to keep that target of your stock bond mix at a particular level. And so consequently, what rebalancing does is after a period of time where one piece has grown and now has a bigger portion, it sort of trims out that extra portion and brings everything back in line to the original investment allocation. All of those are great tools that are available through most employer plans that unfortunately people don't take advantage of enough, be it the automatic rebalancing or the asset allocation or some of the online tools. All those are great tools, and they're helpful and they're powerful. But there's one that is the single most powerful, and that is the feature that allows you to automatically have your contribution amount increase. Let me say that again. A lot of these plans these days, with all of these new features, and there's certainly some good ones between those asset allocations and the online calculators and the automatic rebalancing, and that's all good, okay? Don't get me wrong. You want to make sure your asset allocation is where it needs to be, rebalance from time to time, do some online tracking. But the biggest thing is actually putting more money away on a regular basis. And with the automatic increase in the contributions, that's what happens. So the auto increase works like, let's say you set it at 3%, but then the next year goes to 4%, and the year after that it goes to 5%, and the year after that it goes to 6%. And because that gradually steps up, it doesn't have that dramatic of an impact on your paycheck. But what it means is that you're saving more money on a regular basis. And the reality is that's incredibly powerful stuff that basically forces you or builds it in so that you are saving more on a regular basis. Far too often what happens is people get pay increases. And we say all the time, well, the second you get a pay increase your contribution to your retirement so that you don't get used to that higher level of income, so you don't start spending it, and then ultimately you're just spending more money and not actually saving more money, even though you got more money in your paycheck. Well, the automatic increase in the contribution ultimately ensures that. It doesn't leave it up to you to go in and log in and figure out, okay, where do I go to click the button to increase the amount of the contributions that I'm taking out of my paycheck and putting into my employer plan. The automatic increase allows that to happen automatically each and every year. So we think that's one of the most powerful, perhaps the single most powerful feature to allow people to increase their retirement savings, because left to their own, people generally will not go online and do the extra step to go ahead and increase their savings. They'll get used to making a little bit more money, and then they'll start enjoying that money, spending that money, and then it becomes hard to change that behavior of using and spending more money. So, folks, if you've got an employer plan and if you're contributing, I can't emphasize this enough. You need to go in there today and select that feature. And hopefully your plan does. A lot more of them do now than ever used to. Hopefully that your plan has that feature where you can just click the box and say, I'm going to elect to automatically increase my contributions every year, so that every year I'm putting a little bit more away. Because the reality is, that's how you ultimately really boost your retirement savings. Certainly asset allocation, certainly rebalancing, certainly all of that stuff, that all matters. But the biggest thing that makes the biggest difference, right, is how much you actually put away. So setting up that automatic increase feature on your employer plan is huge, because it does that and it automates it and allows you to avoid having the decision of, oh, I've got to go in, I've got to set it up, I've got to change the percentage, and what's the percentage, and how do I do it, and all those kinds of things. By setting up the automatic increase in those contributions, then you will ultimately be using one of the most powerful tools, or the single most powerful tool, when it comes to increasing your retirement savings, right? After all, it's about putting more money away. And when you do that on an automatic basis, it ensures that it happens. So make sure you check that feature out. That's the single most powerful feature on your employer plan in terms of boosting your retirement savings. We're going to take a break. When we get back, we'll continue the conversation here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio WFLA Orlando. Welcome back, ladies and gentlemen, Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio WFLA Orlando. Hard to believe, right? This past week, it was election day. If you were in Orlando, it was the election for mayor. Buddy Dyer won a re-election, so congratulations to him. Of course, that also means that now, the clock's ticking. We are 1 year out from the presidential election. And I'll save the hyperboles for the mainstream media to go on and on about how it's the most important and all that. The reality is, don't worry, there's one 5 years from now as well. So, and then after that, there's 9 years, and you get the pattern. So each one of them will be always billed as the most important. And they are important, but I'll leave the hyperbole to the mainstream media. Our point is, what's fascinating about politics is it's very widely debated. And no, I'm not talking about just on Facebook. Some of that stuff kind of scares me in terms of the go back and forth between people. If people were face to face, there's no way they would communicate like that, in my opinion. But anyway, I digress. Politics, it seems, is something that we have no problem debating. Religion may even be on that list. But what's interesting is at no point does finances ever come on that list. It's one of those things where, as a society, it's almost like a completely taboo that you would ever talk about finances and anything financially related. And it's funny because when you talk about politics, when you talk about religion, that's got some raw emotion in it. And we don't ever have any problem debating those, it seems like, as a country. But nobody really ever talks about finances. It's like it's a taboo subject. And certainly a lot of the surveys and the studies that are out there would certainly say that most Americans think it's completely impolite, completely rude to engage in a conversation about finances. But our view on that is we think that more people really should engage in that conversation, because just as the sharing of political ideas, the sharing of religious ideas helps to expand your knowledge and helps to expand your perspective, the same thing would be true for finances. But yet, as a society, as a country, we don't do any of that. And ultimately, we think that would be a good thing, is to eliminate this mystery or this perception that it's rude to talk about finances and really engage in that conversation much more. By the way, that's going to be a much more valuable conversation to you than going back and forth with your buddy over beers about Democrats versus Republicans, or Christianity versus non-Christianity. Stop and think about what's going to actually be more valuable to you. How about a little bit of conversation over, should I pay off my car, or should I pay off my house, or should I pay off my student loans? That's a conversation that's actually going to have some merit, actually going to have some value. But as a society, we don't feel that way. So I want to encourage people through this program to start to put that aside, because there's real value in those conversations. And what's sad about it is just how off limits that topic is. I'm reminded of a great post that I saw on Facebook recently. I was scrolling through trying to find it, couldn't find it again. But it was basically a picture of a guy sitting in a chair, and it had something to the effect, and I'm not going to get it right, but we're going to get pretty close. Something about, why don't we stop teaching Algebra 2 to the children of America and start teaching them about debt and finances and balancing a checkbook and saving and paying for college. And probably the biggest reason why that spoke to me was last night, or actually this past week. I found myself having to brush up on my Algebra 2 in order to help my sophomore in high school prepare for a test that he was having on Friday. Now, me and Algebra 2 go way back. There's a bit of a gap, okay? And one of the other things I'll also rail against, which I do at the house all the time, which drives my wife crazy, is that there's no book, right? There's no book. Like, I can't open up the book to like chapter 4.2 and be like, okay, let me just refresh my memory. No, there's no book. It's all online. It's all, okay, which is ridiculous. But anyway, we're digressing. We'll come back. The point is, okay, that if he knew how to balance his checkbook, I suspect that's a skill that he would have for the rest of his life. I'm not sure that his Algebra 2 is going to stick with him, and the quadratic, graphing and all of that is going to really stick with him, okay, when he's trying to figure out, okay, what's the best way to finance my house? Okay, what's the best way to pay for school? Should I take a loan out? Should I lease a car? Should I buy a car? Should I pay cash for the car? All of those different decisions, but yet we're not really, as a country, focusing on that part of the conversation. We'll debate politics, we'll debate religion, and we'll teach Algebra 2. And by the way, my apologies to the Algebra 2 teachers out there. I'm not trying to take your gig away, okay? But the reality is that I think as a society, we could be a lot more practical with our approach to education and focus on teaching kids real skills that are valuable in life. How to balance a checkbook, whether it makes sense to borrow money. All of those things are so much more, have much greater, longer-term impacts. I mean, folks, when you look at these numbers, when you hear these studies, and we've shared them with you over the years, I mean, the percentage of people that contribute to their employer plans is like ridiculously low. The average 401k balance in America is under $50,000. I mean, these numbers, when you look at them, retirement is out of reach for so many people. So many people are in debt. So many people are having to go on bankruptcy. Perhaps if folks had a better understanding and a better ability to feel like you can have a conversation about finances without it being taboo or being off limits or being rude or being impolite, then perhaps we as a country can be in better financial shape. And then, here's my real hope, perhaps that transcends upward to Washington, and they figure out how to balance their checkbook. Those guys all and gals all need to go back to school to figure out how to balance a checkbook, because they certainly don't do a good job with it in Washington. And unfortunately, there's nothing there that's going to break the trend. But I think it starts with, let's not be taboo and have those conversations about finances. It's not rude. It actually may be much more informative than the political or religious debate that you're going to have over the course of this weekend or this week. Something to think about. We thought we would end with that. Just some musings, okay, from somebody who had to relearn Algebra 2 this past week, or at least that part of it. Anyway, we will wrap it up and get on out of here. Thanks for listening to the program. This is Joel Garris of Nelson Financial Planning. You've been listening to Dollars and Cents on News Radio WFLA. You want to catch the program again or see how we look on live video? You can always check us out on social media, all those platforms, YouTube, Facebook, Twitter, it's all out there. Go to the website, nelsonfinancialplanning.com. Go to the upper right, click on your icon that looks sort of familiar, and you'll be directed to the program. Thanks again for listening in, folks. Have a great week.